To help us unpack this a little bit further now, I'm joined in Cape Town by Graham Bell. He's a strategist at Old Mutual Equities. Graham, good to have you with us today. It's interesting as we take a look at the likes of the S&P and the overall global equities environment. It's performing quite strongly, but this wasn't the case last time we spoke when we saw a significant pullback and there was panic all round on the markets. Does this show once again that the trend remains that markets never go up in one direction? In a straight line, rather?
Hi, Gugu. Exactly, that's exactly the point. As you say, a month ago, markets were in free fall. Everyone was fretting about it, and we were talking about it at the time. It seemed quite scary, but at the same time, it was not the first time that we've seen a sharp pullback in this bull market, which has been going on for several years now. And so it looked like the situation would stabilize, and in fact what we saw was one of the strongest bounces in history in this bull market. So it went down very sharply and came back very sharply, but not all the equity markets have moved to the same extent. So the S&P 500, the US market, is now about 2% above its September high, whereas the SWIX, or the South African All-Share Index, is still about 2.5% below its September high, and the FTSE 100 is about 1% below. So it's been a different set of responses. All markets have moved up, but by differing degrees.
Just on that, it does seem as though South Africa's Aussie, albeit it is trading at significantly high levels, but have we been the laggards when it comes to global equities performance?
So what's held the SWIX back has been our resource stocks mainly, and I think the reason for that is twofold. One is that South African fund managers had pretty full weightings in resources 2-3 months ago, and then we started to see even sharper falls in commodity prices than we'd already seen before. So for instance, the iron ore price has fallen as low as $71. And the oil price, as you know, also has fallen very sharply. Copper price has fallen below $3 a pound. And this has the impact of pulling back our resource stocks, Sasol included, which is an oil play, oil and chemicals play. So the South African market has lagged, although it has rebounded along with the others, lagged a bit because of the resources holding back.
Just to sidestep a little bit, should we be worried about the resource performance given the sluggish performance we're seeing out of China and the impact that has on commodity prices?
So yes, the Chinese economy has been slowing down. The growth rate is, although few people will actually admit it, the growth rate in China, GDP growth rate, is probably around 6% at the moment, 6.5%. The indicators that I look at indicate that that's the kind of rate we're running at. A lot of Chinese analysts don't really like to admit that it's fallen below 7%, and the Chinese authorities themselves are busy revising down their growth forecast from 7.5 to 7. So they don't want to let go of the 7 number, they like to hold on to that. But in reality, the number is closer to 6. So that has, plus the fact that the European economy has also been in a slow growth phase for the last 3 or 4 months. That's starting to change though. In Europe, the data you mentioned in your preamble now, that the French confidence index was up, and yesterday from Germany we saw the first rise in the ZEW business indicator for the year, and we also saw a very buoyant report on European car sales running at over 6% year on year. So there seems to be a turnaround now in the outlook for Europe, and I think that a lot of the media have been very down on Europe, been very negative, and I think you're going to find that that's going to start to recede now, and Europe will get back onto a better growth path.
What about the US, Graham?
Well, the US data has been very supportive across the board, particularly the employment numbers. Yesterday we saw an indicator called the National Housing Bureau Index, which is a measure of interest in housing and in purchasing housing. It shows the traffic of buyers through houses and so on. And this index had a sharp bounce well above expectations and registered its second highest reading since the global financial crisis. And this indicator overlaps quite nicely with house price changes in the US. And house prices have actually, they've been growing, but the rate of growth has slowed down quite a lot. And I think you're going to start seeing the tempo of house prices picking up steam again. So overall, the news from the US is pretty positive. We also saw some data from the UK yesterday that the inflation rate picked up from 1.2 to 1.3%. It's really a non-event, but the point really is that inflation in the UK has fallen steadily for the last 3 years, and this is being aided by the decline in the oil price. And the fall in the oil price of this magnitude across the world of 20 to 25%, depending on what currency you're in, is really tantamount to a big tax cut for consumers. So I think looking forward over the next few months, you're going to see a pickup in consumer spending, and that will surely result in a pickup on the supply side as well, in terms of industrial production and so on. So I think the outlook in the short term for economic activity is starting to look more positive, and this sharp decline in resource prices, particularly iron ore and oil, will probably be arrested, and they'll probably stabilize at these levels.